Welcome to Invested in Climate. Protecting the planet and decarbonizing the global economy is the challenge of our time. We all have a role to play, and the opportunity we face is unprecedented. Invested in Climate aims to help people do more to address climate change through their work, investments, lifestyle, and activism. I'm your host, Jason Rissman. I support a growing community of top climate and ESG leaders as the Chief Experience Officer at NationsWell, and I'm an advisor to the climate practice at IDEO. I'm also an investor and startup advisor, and when it comes to climate action, I know I'll be a lifelong learner, always looking to have more impact. If you like what you hear, give us a good rating on Apple, Spotify, or wherever you found us. Sign up for updates and suggest ideas for future episodes at investedinclimate.com. Follow us on social, subscribe, and spread the word. Thanks for joining.
At its foundation, climate is the mother of all industries. It's improving everything that supports human life and the planet. And there's a lifetime of work that we will do here to change over all industry and all the things that support human life. And there's a lot of money to be made. And we believe supporting founders is a major lever for impact and sort of finding all these opportunities and creating value propositions that can support the transition. So we are more excited than ever before.
Hi, folks. Earthshot Ventures isn't just any climate tech venture firm. Having grown out of Elemental Accelerator, one of the biggest and best reputed accelerators in the industry, Earthshot is deeply rooted in the early stage ecosystem. And turns out there's something else that sets them apart. Managing partner Mike Jackson has a knack for coaching founders on what he thinks of as the art and science of fundraising. We're joined today by Mike, as well as Earthshot partner Ramsay Siegal, to hear about their firm, approach, portfolio, and outlook on the market. We dive deep into Mike's insights to helping founders raise money, and we talk about non-dilutive project financing and hard-to-abate sectors, about the opportunities AI is bringing to climate tech, about several of their portfolio companies, and much more. If you're interested in early-stage climate investing or startups, there's lots to learn in this one. Hope you enjoy. Okay, here we go. Hey, Ramsey. Hey, Mike. Welcome to Invested in Climate. Great to have you both here with us today.
Thanks for having us.
Great to be here.
Great to be here.
Great. Well, it is great to have you here with us. Great to reconnect with you, Ramsey. Mike, great to meet you. So excited for today's conversation. Before we dive in, would love to just learn a bit about each of you, and we'll spend lots of time getting to know Earthshot Ventures, but let's hear about both of your backgrounds just a little bit. And going through your backgrounds was a lot of fun as you both bring really interesting experience prior to joining Earthshot. Mike, let's start with you. You've been an investor and entrepreneur in climate tech for over 15 years. Tell us about the major stops along the way before arriving to Earthshot and how they prepared you for the work you're doing.
Sure. I've been interested in climate for just about my whole life. I studied clean energy in college, did an undergrad and master's in energy engineering. And so kind of come at it from the approach, from the science-based approach, and I've kind of gotten into the financial side over time. I ended up starting a company in the first wave of clean tech in Silicon Valley in the mid-2000s. It was a company in the carbon offset market and renewable energy certificate market. Started with a co-founder, built it up, and had a tremendous amount of experience doing that. Developed a lot of humility about the difficulty of the founder's journey, and ultimately decided to make the switch over to the investing side. I ended up joining a firm in 2009 called the Wesley Group. The Wesley Group was raising its first fund at that time, joined them as an intern, and then after a couple of months, got a full-time job there. I stayed there for 9 years, got a tremendous amount of experience working on kind of all aspects of VC there, everything from sourcing to leading deals, sitting on boards, doing fundraising, all the rest of it. Just an incredible experience. After being at the Wesley Group, I ended up joining a firm called Generate Capital, which is a project financier in the space. Learned a tremendous amount about how non-dilutive funding works, just a lot about how that different asset class thinks about investing across our ecosystem. Then also worked at Elemental Accelerator, which is probably the largest accelerator in this space, and worked very directly with all of their CEOs as they went through fundraises, specifically the VC on their team, kind of helping them think through that, strategize, part therapist as you go through that whole process. And kind of through that relationship with Elemental, we decided to spin out a fund and create a fund. And that's what Earthshot is. So that's the quick and dirty how I ended up here.
Fantastic. Thanks, Mike. Ramsey, over to you. We'll, of course, get to circle back and pick Mike's brain a lot and be able to tap into all that experience. But Ramsey, would love to hear a bit about your background and how you developed the expertise that you're using at Earthshot today.
Yeah, absolutely. So I'm Ramsey Siegal, partner at Earthshot Ventures, and have been working in climate for 16 years now. And there's no one experience that has sort of helped me every day at work. It's a combination of things over the years. So to start at the top, I graduated from college, studied architecture, and decided that I was more passionate about decarbonization than the design of buildings, and joined Chevron Energy Solutions and sold solar and energy efficiency projects to public sector clients, such as colleges and universities and K through 12 campuses. And at the time, the power purchase agreement, it was just emerging as a tool to enable customers to buy solar and energy efficiency projects without any upfront capital. So it was a really interesting time to be sort of tip of the spear at this organization right out of college, selling direct to customers, getting their feedback, incorporating that into how we positioned our product and how we sold our product and the products that we offered. And then also seeing how finance is an enabler for sales and commercializing more clean technologies. So that was a wonderful experience. Then I went to graduate school and studied smart grid technology, sort of continuing to follow that curiosity around decarbonization of the grid. And I joined a startup after grad school called eMeter, which had sort of pioneered the concept of a meter data management software platform. So taking information off of smart meters, cleaning it up and presenting it for billing. So core sort of software infrastructure for utilities. And then once you had all that data, you could run analytics, you could control the meter with a smart connect disconnect offering. So there were all these upsell opportunities for us. And we sold first in Europe. And then after the company was acquired by Siemens, we sort of grew Asia Pacific markets. So I spent a lot of time in Japan and Kuala Lumpur, in Manila, and then in India, working with customers and helping these major utilities incorporate smart grid technology into their businesses. A lot of sort of early career people ask me how to get into climate. And one thing I recommend is join a sales team. Like, you learn so much, you're right in the thick of it. And there's a lot of rich learnings and feedback that you get from customers that you can use later down the line in your career. And then I joined Elemental Accelerator, which gave more of a meta sort of portfolio view of how to create climate impact. When I joined Elemental, we had 25 portfolio companies. At the time that we spun out Earthshot Ventures, we had 125. So we made 100 investments in my time there and grew the team, grew our deal flow, and grew our portfolio services. So all of those experiences are incorporated into how we support our companies and how we think about commercialization in this sector.
Amazing. I love the advice of joining a sales team. Never heard that before, but makes a lot of sense. Both of you mentioned Elemental Accelerator, a place where you were both involved before joining Earthshot. So I think a good starting point is really understanding the relationship between Elemental and Earthshot. Mike, can I go to you and ask for the backstory?
Sure. Yeah. So as I was kind of finishing up in my background in early 2020, just kind of based on a lot of the progress and traction that Elemental companies were getting, started to think about creating a fund. Don's the CEO of Elemental. We got together and started to design, how would this work? How could we build an independent fund that would be able to kind of find the best and brightest companies, but also have this really strong DNA from Elemental, a strong kind of collaborative fund with the accelerator. So we spent 2020 kind of designing that whole platform. We both exchange company intelligence back and forth. We exchange deal flow back and forth. We exchange networks across the two organizations with the belief that networks are going to be the most effective way at finding, evaluating, helping companies. We ended up raising the fund in 2021. We've now invested in 22 companies. Some of those are companies that were part of the Elemental portfolio previously. Some were companies that Elemental referred to us, but weren't portfolio companies. And the reverse has been true as well. We have found some companies that we ended up investing in that ended up going through the program and referred some others on as well. So it's been a really collaborative and fruitful effort across the two organizations. And then Dawn Lippert splits her time between the two organizations. So Dawn is the CEO of Elemental, and she's the other general partner at Earthshot. She just brings a lot of that connective tissue across the two, a lot of that community organizing kind of elements of kind of corralling the investor ecosystem and the startup ecosystem into kind of the DNA of Earthshot.
Fantastic. Well, Mike, you described Earthshot, obviously a climate tech venture firm. You're investing across different verticals. Tell us a bit more about your investment thesis and specifically what you're interested in and what sets you apart from other venture firms.
So for us, we're an early stage venture fund. Our kind of sweet spot is seed through Series A. We tend to lead at the seed stage. We tend to follow at a Series A. We probably, like most people listening to this podcast, have a strong belief that the climate transition is going to be both a huge transition of the overall economy and a tremendous economic opportunity. We see there being very large opportunities across a whole group of different industries, whether that's in the energy space, mobility, industrial, food, and agriculture. So we're open to opportunities in all of those areas. We tend to have the mantra that we want to find the most interesting teams, and then we want to kind of figure out what it is that they're doing. We think that the smartest, most kind of diversely talented groups of folks are going to be the types that are most likely to find the most interesting problems. It's our job to then kind of join on board, support them, figure out where we can kind of help them. In terms of our focus, what we tend to really gravitate towards are playbooks from other industries and where those come into climate. So playbooks that have produced big financial outcomes before. Easy examples from that might be examples from the generalist tech industry, so B2B SaaS models, marketplace models, data as a service model, computer vision, those types of technologies where they intersect with climate. We have a high degree of confidence that those are going to produce some very large financial outcomes. But some of the analogies that we found have come from other industries. Some have come from biotech. One of our investments we really thought was really replicating the playbook of Moderna. We all saw spectacularly succeed for all of us in 2021 in terms of their vaccine development. There's a company called Mitrachem that's employing a similar playbook in the battery material innovation space. It was actually our first investment out of the fund. And then lastly, some of the companies come from analogies across the general energy space. So I think having an understanding of where value, where profits occur and accrue in the energy space gives us some clues as to where those things are going to apply in the sustainable transition. One example of that is a lot of the profits in the oil and gas space tend to flow upstream. The owners of the resources tend to be the ones that produce the largest profits. And we think something similar is probably going to happen in the battery material space, which is why we've invested in companies like Mitrachem, companies like Cobalt Metals and Lilac Solutions. We think they're following similar playbooks that we've seen be effective elsewhere in the energy space. That's a little bit about philosophically how we think about the types of opportunities that we probably get most excited about.
Thanks, Mike. I love the focus on playbooks and how those create strategic insights. Ramsey, let's turn to you. Part of Earthshot's differentiation is your connection to Elemental Accelerator and your network. And a lot of venture firms will tout their network as special. Is there something that's really different about yours?
I'm so glad you asked this question because we think of ourselves as a network fund and as really supercharging our founders with the network when they come into our portfolio. And I think what makes ours different is the length of time that we've been developing this network. So the last 10 to 15 years, we've been cultivating relationships with founders, investors, potential customers, project financiers, government officials, that if you sort of think of them as hugging the startup, creating this environment where they can be successful. I think another thing that stands out are the number of companies that we've invested in collectively, which is 200. And we have a pretty deep relationship with most of these founders. We have deployed projects with them in the context of Elemental, sat on their board, spent a lot of time with them. And so that has so many positive impacts on our work. We get referrals for potential future investments from our founders, and we cultivate peer-to-peer interactions between them as well. The last thing I'll mention on this is that Elemental has invested in convening the community over the years. So I believe this will be the 11th interactive that Elemental hosts in San Francisco, which is one of the largest climate investor-focused events of the year, which has the entire portfolio from Earthshot and Elemental, and then investors across the spectrum. And these in-person events, I think, create a lot of stickiness and community and relationships between the ecosystem that supports companies as they're commercializing.
Amazing. You know, I'm located nearby, so I'll wait for an invitation.
It's coming your way.
Okay, fantastic. All right. Another thing that I've heard that sets you apart is Mike and Mike's experience when it comes to fundraising and the time that you invest in coaching your portfolio. I'd love to learn more. So, Mike, will you tell us a bit about your approach?
I think this is something I started to do at my time at the Wesley Group. I just tried to figure out how to be valuable around other folks and found that being a really tactical kind of support and coach to CEOs as they went through the process, helping them build up an investor funnel, helping them understand how to build a data room, how to kind of structure their deck, et cetera, could be really useful. And then at my time at Elemental, I just got a tremendous number of repetitions. I probably worked with 80 companies going through fundraisers, everywhere from seed stage through Series D, helped companies with those equity rounds, helped companies with acquisitions, helped companies with raising project finance. So I've just spent a lot of time in that environment with companies. My approach is always to try to boil it down to its component parts. We would usually walk through with people that the kind of four major parts of a fundraise were: number one, thinking through your strategy. How much are you going to raise? Valuation expectations, type of money, who on the team's going to get involved, timing, those kind of tactical questions. The second was around document creation. So your deck, data room, and financial model, and how to build those documents, but also how to build them with the perspective of the job of the investor on the other side of the table, just the understanding that that person's probably writing an investment memo. They're playing a game of translation to their colleagues or a game of telephone to their colleagues. And so how do you build those materials in a way that helps with that, helps them do their job more easily? Third is in helping people build up their funnel. I think it's very important to run this like a traditional sales process, build up an investor funnel, maintain one even when you're not fundraising, continuously collect ideas and relationships with investors throughout your life as a CEO. And then just thinking through the different strategies around how you activate that funnel. And then lastly, helping companies through closing. So helping companies kind of think through what's in their term sheet, understanding why this term is in there, how to kind of think about and negotiate their way through that. And then the last area we spent a decent amount of time with is, for a lot of companies, they end up raising a round of funding. And it's congratulations, nice job, kind of the first call post fundraise. And it's like, you've got a board meeting coming up soon. Have you ever even been to a board meeting? Do you know what happens in there? And would sit down with companies and really help them think through how they might structure that deck, how to set up the board meeting to be both fulfilling their obligations of reporting to their investors, as well as figuring out how do they get information and get support from their investors. The ideal board meeting is really 50-50 on those two sides. And I think a lot of times the board meetings can end up being too much of just a reporting event. That's been the kind of overarching structure. And then what I usually like to do is kind of flip that to the CEO. And most of my coaching calls just start with, what do you want to talk about today? In general, people are very comfortable with certain aspects of the fundraise, but they know there's certain areas that they don't really know or understand. A Series Seed company is obviously going to have a different set of questions than a Series C CEO who's raised a number of rounds before. But often just kind of having that thought partner of somebody who's been a part of several hundred transactions, and it's just seen how they play through, been on 4 different investment teams to kind of understand how decisions are made. I can usually be a pretty helpful sounding board to folks as they go through that process.
Thanks, Mike. Sounds like it's incredibly helpful to have you at a founder's side as they go through the process. Tell us some of the tips and tricks that you emphasize. I've heard that you see fundraising as an art, and I'm sure many listeners are eager to hear some of the details. What can you share about the methods behind the art of fundraising?
There is definitely a blend of art and science in all of this. Maybe a couple of quick tidbits for folks, and obviously go in a bunch of different ways. One of the most useful things that I think good CEOs tend to do when they go through a fundraise is they bring in some support. A CEO who is raising a round of funding entirely by themselves, which is often the case, it's difficult to do. You're running a company, you're managing a team, you're trying to run a fundraise. And the reality is a lot of the parts of a fundraise can be done by not the CEO. The highest and best use of the CEO in a fundraise is spending time in pitches with investors and kind of signing off on the final answers to diligence requests, et cetera. But all of the building up of a funnel, evaluating that, deck edits, building up the first versions of financial models, et cetera, all of those things can actually be done by somebody else on their team. And so finding a business school intern or a junior person in the finance department to help you through that process is really, really helpful. It's also for folks who are looking to get a role in venture, it's a great way to get exposure to it as a business school student. One of my former interns is now a VC at a prominent venture fund. She learned a lot about this experience in going through a fundraise. So that's one useful piece. I think another to mention is really think about and appreciate what's happening on the other side of the table. Your VC is probably writing an investment memo. The sections of that investment memo probably largely correlate to the 15 or so slides that people will describe as the kind of VC pitch slides. What's the market size? Who are your customers? What will your gross margins be, et cetera? When you think about how you build your deck, and especially when you think about how you build your data room, a lot of that is in trying to almost write the pieces of that investment memo for the investor. I know you're going to look into market size. I know you're going to look into competitors. So why don't I summarize this in a series of small little decks, little 5 to 8 slide decks in that data room, because that's now digestible. That's something that you can take to your colleague who's concerned about the competitive dynamics. And then you shift the VC's job from one of, hey, this was interesting. Now I got to go do a ton of work to do all this research, to they can kind of just edit and editorialize what you've produced for them. It makes their job so much easier, and it allows you to control the narrative of that game of telephone that goes along. So some of those kind of skills associated with it and that understanding of what's happening on the other side can be really helpful to people as they go through that process. There's 50 more little tidbits like that, but those are a couple of the pieces that I think folks have used very effectively.
So the venture scene has taken a wild ride in recent years. Mike, venture financing was growing spectacularly a few years back when Earthshot was started, and then recently contracted last year. How did you coach your portfolio through that downturn, and what proved most effective for them during that rough patch?
So I've certainly been a part of some wild upswings and wild downswings as somebody who was involved in the first wave of clean tech, as well as some of the aftermath in the 2010s. I think a couple of key pieces. Number one is the cardinal rule of startups is not to run out of money. So figuring out ways to raise money, figuring out ways to cutting burn, figuring out ways to partner with strategics are really, really important and key pieces of survival. Fundraising earlier than you think you may need is obviously a very important thing. Fundraisers have taken longer in this environment. All that said, good companies are certainly still raising money. This is not the same story as we saw in, say, 2012, 2013 timeframe, where everyone was pulling out of the sector. There's a lot of funds still around. They're very active. Good companies are continuing to raise money. I think companies being highly pragmatic at this stage is very important around valuation, around cash management, and around an emphasis on traction. In environments like this, traction tends to be what enables companies to survive. So really focusing on the kind of here and now, hitting your quarterly numbers around revenue is absolutely essential at these stages. But all of that, frankly, is probably good advice in an up market too. So some of it is just kind of sticking to the fundamentals.
Thanks, Mike. Ramsey, let's bring you back in here, as many of the portfolio companies are ones that you work with. From your vantage point, how did the companies benefit from Earthshot and Mike's coaching about fundraising? Are there any success stories you can point to?
Definitely. So we brought Mike into Elemental in 2017 to start coaching companies, since we noticed that this was a major pain point. And as Mike mentioned, founders are looking to run their company and fundraise at the same time, essentially having two jobs. And so the shorter we could make the fundraising cycle, the better for the company. I would guess that there's about 50 success stories, and some of the companies he's coached have gone public, others have been acquired, others continue to grow and be strong. I think one thing I've noticed is that his coaching is part sort of counselor, or sort of the psychology of fundraising, and having someone who's non-threatening to talk to about these difficult questions, and then part tactical, as he mentioned. So all of it is very helpful to a founder who's navigating the challenge of closing each round. In terms of recent successes, there was a company in our portfolio who was having difficulty finding a lead, and we were a small lead to spark around. And I think Mike has a very keen sense that a lot of this is based on momentum. So if you can tip the first domino, then many other dominoes fall and the money comes in and the company successfully raises. So in some cases, if we're the first domino and the company closes a much larger round, then they get back to building. And I think that's a huge success.
Great. And Ramsey, where would you say we are now? Have we made it through the rough patch that Mike was talking about? And has access to capital been improving?
I haven't seen access to capital be a problem at the early stage. It certainly has slowed down at the later stages. Many climate funds were raised during the pandemic, which means that there's still a lot of dry powder on the table. Some are getting closer to the end of their funds, probably in the next year or so. But there are certainly many funds out there looking for investable opportunities. And I think for founders listening to this podcast, obsession with traction will make fundraising easier in climate. So as Mike mentioned, everything becomes easier when you have traction. It's easier to find more customers. It's easier to find investors. It really speaks for itself.
Thanks, Ramsey. Mike, we've been talking really in broad strokes, but of course, we all want to hear more about the portfolio companies. A lot of folks are excited about AI's potential for accelerating climate solutions, and I know that software is a big focus for you all. How is AI showing up in your investment thesis, and are there any portfolio companies that reflect AI's potential that you'd like to mention?
As you mentioned, AI is having a big impact in climate already. I would say the solutions that we see in climate tend to be solutions that are making the job of an engineer much easier, enabling them to move much faster, and kind of hand in hand with engineering teams. So it's kind of this human in the loop style AI. I mentioned earlier this company, Mitrachem. So Mitrachem uses AI to innovate around battery materials. So you can kind of think of it as the typical battery material company has a particular chemistry that they're pushing, and they attempt to develop that chemistry. Mitra is more like an idea machine for battery chemistry across using AI. And so the way that they do this is they run a series of experiments. They use the AI to predict what's the logical next set of 100 experiments that we could do to both prove out that false positives are indeed that, kind of avoid a cul-de-sac in development, as well as to kind of push the frontiers of what we might do. And so the combination of that AI and rapid throughput enables them to innovate incredibly quickly. So they're not beholden to any one specific technology path that they may go down. They can build application-specific batteries because every application today is kind of using an imperfect battery that has trade-offs around weight and energy density and power density and the like. So if you can build application-specific batteries, it'll typically outperform even a ultimately better battery in a kind of more traditional sense. So that's been fascinating. They've announced partnerships with GM. They just recently announced a partnership with Saint-Gobain to help them commercialize the technology. We're investors in Cobalt Metals, which is a company that's combining AI with the world's geological data. So Cobalt is collecting geological data from every source imaginable. And then it's this incredible team that is then analyzing that to predict where are the precious metals of the sustainable energy transition going to be located? Where are the lithium, copper, nickel, and cobalt deposits? Where are they going to be found? I was on a call with Kurt the other day, and he was saying, I forget the stat, 98% or so of the metals in this transition are from mines that were observable at the surface. And just said, that's not where all these things are. A lot of them are hiding in other places. And if you can build a knowledge set that helps you understand where they may be located, you have an information arbitrage opportunity across an enormous financial asset class. And so similarly for them, it's both being able to kind of predict and push these frontiers, but also being able to identify false positives really, really quickly. For them, it's driving down what is the cost per major discovery. Can they drive that down by an order of magnitude or even more? So far, we've now seen that play out. They've announced their first extremely large deposit, which is a copper mine actually located in a copper producing region. And so it was something that was hiding kind of under everybody's nose, but they were able to find. And so we see them as somebody who's going to be able to almost systematically produce these opportunities over time. So those are a couple examples. We have a number of companies where it's just flowing through other parts of their business. We have a couple of companies in the computer vision space, Aquabyte and Noteworthy, who are using it in the case of Aquabyte to help improve the efficiency of aquaculture, to understand the impact of feeding at different schedules, to understand the growth of pests in aquaculture facilities, as well as a company called Noteworthy that's mounting cameras on trucks that are driving around doing a utilities business otherwise. But while it's doing that, it's diagnosing faults throughout the distribution infrastructure, identifying vegetation encroachment, being able to kind of piggyback on the existing efforts to provide utilities with that intelligence. So I think it's going to change a whole lot of things across a bunch of different sectors. So it's a trend we continue to, I know it's hyped and it's something that people sometimes suspect maybe some sort of a bubble, but we're seeing firsthand it really changing business operations in a number of different industries. So we continue to be excited about it.
Thanks, Mike. Let's go a little bit deeper. I'd love to learn more, not just about the companies that you've already invested in, but I'm curious, where are there spaces where you think AI can be a game changer and that you're excited to invest in? Ramsey, any thoughts that you'd like to share?
Definitely. So I think software was the first step to digitize the world, and AI just improves the outcomes and insights from that foundation that has been set. So I don't think there's one technology category that will benefit from AI. I believe every single corner of the climate tech community will benefit from AI in the months and years ahead. And I've been really impressed with our portfolio at the rate in which they're adopting AI to improve the outcomes from their technology that they've been building. Another thing that I think is worth mentioning is the best companies are including AI in the core functionality of their business beyond the product. So, for example, we have a company called Parade that sells software technology to freight brokers to improve the number of loads that a freight broker can fulfill on a daily basis. So it's an order of magnitude improvement to adopt their software technology at a baseline. And then the AI assist that they are rolling out now, again, is an order of magnitude improvement. In addition to that, they're incorporating AI into their business. And one example is qualifying sales leads so that before a sales rep picks up a phone to call a potential customer, the AI is giving a high likelihood that that person on the other end is indeed a freight broker. The efficiencies that can take place within the business can make the whole effort more efficient. And we're really excited about those gains as well.
Let's turn to hard-to-abate sector, something that's, of course, important to talk about and even more important to invest in. And that's what you're doing. Kanin Energy, a company that is focused on helping the industrial sector decarbonize. Let's hear about them. Would love to understand what the company is and why you invested.
So this one's near and dear to my heart because it was an existing relationship with the founder. So I worked with Janice Tran at Generate Capital. Janice built the waste to value business at Generate. She was one of the core people in building those efforts. And so she saw firsthand both how waste businesses work and operate, the challenges in that space. And I think what she also generally saw was that there's actually a lot of money able to invest in interesting opportunities in that ecosystem, those that can sign the right sorts of offtake contracts and get the right type of supply. The challenge was actually having developers that could put together those kind of bankable, fundable projects. And so she decided to start her own company. So Kanin is a developer in that space. They are not a technology company. So from the get-go, it was important for her to build a business that was using existing technology. The way I think about Kanin almost at a very high level point is there's a number of technologies that are installed in, let's say, 40 or 50 sites worldwide, but ultimately pencil in 2,000 of them. What is needed to make that transition is really folks to get involved, put together those contracts, put together those structures, and really do the heavy lifting of making those installations happen. What's nice about that then is the company has no trouble raising non-dilutive funding. So Kanin right now is at the very early stages of deploying their first 4 projects. It's well over $100 million of CapEx, but the company's only raised about $6 million at the corporate level. The ability to do that, we think, makes them this very interesting kind of important nuance, which is there's a capital intensity associated with what Kanin does, but at the corporate level, it's extremely capital efficient. I think that's a common misconception around developers in this space. So super excited about what they're doing. We just recently raised another round that we helped lead and bring in a really wonderful value add investor, a group called Wallamai based in Australia. They're really helping the company think deeply about accessing that market and have even a deeper background than me on the project finance side. So super excited about the traction that they've gotten, the team there, continue to be excited about that one.
Mike, I'd love to rewind just to better understand what you described, which sounds probably to some investors like magic, right? A company being able to raise large amounts of capital without dilution. So do you mind going back into that and telling us a bit more around how Kanin does it? And is it unique to their model and to their type of project development? Or is that something that hard-to-abate sector companies are finding opportunities in?
It's a really important point and nuance and important for companies to understand. So you can think of the money that we've invested going into the corporate equity at Kanin. And so the job of that company is to go out and find these projects, find sites that have a tremendous amount of waste heat, decide what technology makes sense to be installed in that site, figure out the contractual relationship with the site of, You're going to be supplying me with this quality of waste heat for this amount of time at this specific price. And it tends to be really important to make sure you can contract all of those elements and to do so for a long period of time. Often these contracts are 20 years or even longer. And then similar, this unit's going to produce electricity. Well, who's going to buy the electricity? Is it going to be on site? Are they going to sell it back to the utility? And similarly, because you're deploying tens of millions of dollars in infrastructure, you want to make sure somebody's going to pay for it. Somebody's going to pay for it for enough time for the investors to recover their invested capital. But if you can do all of that, what you end up doing is you create effectively a special purpose vehicle. You think of that unit as being its own little company. It has an investor that comes in and starts the company up by deploying, let's say, $50 million worth of CapEx into it. And then that company starts to have costs. It pays people to install it. It has operating costs on a regular basis, but it also starts to produce revenue. As the revenue comes back from that project through electricity sales, that flows back into this tiny little company. What the company will typically do, and the relationship with the financiers will typically be that the financiers get preferential treatment on those returns up until a trigger. And then the economics will tend to shift. So I kind of think about it as you have sort of a pre-trigger pie chart, which will usually heavily favor the money that invested in making the project happen. It tends to be a very risk-averse asset class in terms of project finance. But then once the project hits the trigger, often it's either a 1x cash-on-cash return or a particular IRR threshold. That pie chart will tend to flip, and it'll flip then generally strongly in favor of the entities that produce the project. It can get a lot more complicated than that. There can be 10 pie charts and 14 different triggers and you name it. But at the highest level, that's how these things work. And then for a company like Kanin, they have multiple types of revenue streams. They can be some of the service providers that help these projects happen. In some cases, kind of more technology companies, they will actually sell their equipment to this SPV, and that's a revenue opportunity for them. If there are consumables in the context of the plant, they may sell those consumables to this project and make revenue that way. And then lastly, they are equity owners in those projects. So as those projects exist and last for many, many years, Kanin can get a stream of cash flows from them. They can also decide at some point, hey, you know what? I'd rather get more cash sooner because I'm a fast growing startup. And so they can then sell off those future cash flows of, we're going to be receiving a check for X millions of dollars for the next 20 years. Could we take a slight haircut on that and send that to an entity that has kind of a lower cost of capital, a longer time horizon, and then use that to commercialize the business and find the next wave of projects. So when employed correctly and when all those pieces come together, project finance is an unbelievable amount of jet fuel for companies in this space. But ultimately, it does come down to making sure that you can check a lot of those boxes from the project financier's perspective. And I think that's where I think Kanin had obviously a very strong appreciation for what that takes based on Janet's background. It's something that we understand very well at Earthshot, and it allows us to invest in the sorts of companies that are probably more suited to this type of money. I think a lot of people talk about project financing in the climate space, but certain types of companies, certain types of opportunities are just dramatically more likely to be able to attract it than others. I think that helps us from an investment perspective to understand those distinctions. And then it helps us help these companies because I've been the one giving the test in the past, so I can help teach companies to that test. So when they do show up to talk to a company like Generate a number of years later, they know what the questions are going to be. One of the things that was always frustrating to me when I worked at Generate is I would ask certain questions about the credit quality of your supplier, or can we narrow the price bands around what your customer is going to pay you? And the natural entrepreneur reaction is, well, I think the prices are going to go up, so I don't want to be locked down now. But now you've introduced risk in the project and it makes it harder for somebody to fund it. So just really understanding how that type of money works is a key value to entrepreneurs in this space. My little soapbox of just wanting to kind of teach that to early stage entrepreneurs so that they can build better businesses in this ecosystem.
Thanks, Mike. Really appreciate you getting into the nitty-gritty, super interesting stuff. Ramsey, let's turn back to you. I noticed that almost half of the CEOs you're invested in are from underrepresented groups. Tell us about Earthshot's commitment to DEI and any tips to staying committed and achieving a more diverse portfolio.
So, as you mentioned, about half of our CEOs come from underrepresented groups in venture, and about a third are female founders. And we don't have a quota as an organization for DEI. We're investing in the very best founders. We're obsessed with this idea of searching for A+ founders to lead our portfolio companies. and they happen to be more diverse on average. And I think this is largely due to our DNA coming from Elemental Accelerator and the point of view that Elemental has around the best and strongest and highest performing companies in climate will be diverse led and be diverse across the spectrum at the board level, at the founder level, across the company. And that diverse companies also have an easier time deploying their technology with customers and in communities in which we all live. And we've seen this a number of times over the years deploying technology. In terms of tips, I think DEI isn't something that you do at the surface level or in one corner of a business. It has to be incorporated into all the decisions that you make. So beginning with diversifying your own team, hosting events that might be for particular groups. So for example, in April, I'll be hosting a female founder and funder event with Sophie Purdom at San Francisco Climate Week. And this is just to create community and consolidate the female founders and funders, which may lead to transactions, may lead to future job opportunities. So much good can come from that. And also sort of puts our stake in the ground that that's something that's important to us. There's little things that we discovered at Elemental, like diversifying the imagery on your website, being more representative, and asking difficult questions of companies around board and executive team diversity. And so we're not afraid to say, hey, we noticed that the board all has one sort of representation. Having diversity could be of value to you, and we're happy to help. We have a great deep network there, and let us know what's sort of the skill sets that are most important to you, and we can provide referrals. So I think all of these things, some are large, some are small, and all of them roll up to make a difference and roll up to those larger figures that you mentioned.
Great. Thank you, Ramsey. Let's leave off with where you think we're headed. Mike, how do you describe this moment to investors that are considering getting involved in climate tech investing?
I mean, it's such an exciting time. We have seen for the last 15 years so many of these industries grow in a spectacular fashion. The transitions that we've seen in the EV space over the last 5 or 6 years are just absurdly dramatic. The changes that we've seen in the power space in terms of the penetration of solar and increasingly solar plus storage, all of these industries have grown a huge amount. The innovations we've seen in the food and agriculture space are remarkable, totally changing the way that we're going to produce, buy, and consume food over time. What gets us continually excited about that is that as these markets grow, they just create big niches. Opportunities that made absolutely no sense as a business model a few years ago now become multi-billion-dollar investment opportunities. You take a company like Aurora Solar, now a multi-billion-dollar solar software company. 10 years ago, that was just an absolutely puny market opportunity. But as the industry has grown, it's become a very, very large niche. That business looks a much more like a traditional venture style business in terms of offering B2B SaaS to a wide range of customers. I think it's that growth of these industries. They're not going anywhere, whether the fad of climate investing is hot or a little bit cooler. All these industries are transforming dramatically quickly. We just continue to see this being a very important long-term trend, a very lucrative long-term trend. We're excited to be able to work with some wonderful people on it.
Thanks, Mike. Ramsey, we're going to give you the final word. What about you? How do you see the opportunity for investors today relative to years past, and what do you see coming ahead?
Yeah, I agree with everything that Mike said. I think this is the most exciting time in history to be investing in climate and supporting founders that are building in climate. And in years past, especially the early years, it felt like we were climbing up a big hill and trying to convince people that there was value here. And it really feels like the wind is at our back. There's more capital than ever before. There's more diversity in the capital stack. There's more support through incentives and policies and organizations like accelerators that create the support network for founders. At its foundation, climate is the mother of all industries. It's improving everything that supports human life and the planet. And there's a lifetime of work that we will do here to change over all industry and all the things that support human life. And there's a lot of money to be made. And we believe supporting founders is a major lever for impact and sort of finding all these opportunities and creating value propositions that can support the transition. So we are more excited than ever before.
Mike, Ramsey, thank you both so much for your time today, and best of luck with all the work that you're doing.
Thank you, Jason.
Thanks so much for having us.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.